Hello everyone, how's it going? In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. As the market has been very volatile recently and active over the past few weeks, the future outlook looks as uncertain as ever. We will go through the latest fundamentals, price actions, and my analysis, as well as the recommendation to hopefully help you make the best decision possible. Before we begin this video, I'd just like to state a few points that should make both my life and yours a lot easier and more constructive as well. What I'm going to say in this video are going to be my opinion or my interpretations of how things are and will be. They should not be considered as investment advice, but only for entertainment purposes. If they can help you make better decisions, then my job is done. Most of my analysis is also done in the immediate past or a few days before the uploading of the videos, and the price action may no longer reflect the price action when you see it by the time it's uploaded. This, however, shouldn't matter too much, as it can always serve as a tool to analyze the current momentum. Also, keep in mind that the analysis will try to cover the stock as comprehensively as possible, and it's going to talk about more factors than the latest news or price actions. For example, the company's financials, the stock market trends, the long-term perspectives, and the shareholder behaviors are also give us important factors to consider to affect the timing, the quantity, and the actual decision to either buy, sell, or hold the stock. Because most of my viewers are watching the videos for the first time, it does matter for them to consider all these factors in my videos. So with that being said, let's begin with today's analysis. Mullen is an EV manufacturing, distribution, and marketing company. It acts as a holding for several brands and companies that they have bought along the way and over the years. The latest one is Muln and its EV trucks. The company has been operating since 2014 and it is a successor to Coda Automotive. There's another company called Mullen Motorcars before, and it developed Mullen GT, one of the earliest EV supercars in the market back in 2007. Overall, it's fairly convincing to say that Mullen is an EV veteran, so we can say with a fair amount of certainty that they have been around the sector for a long time and they have a convincing track record to at least make sure that they're not a bunch of scammers just to get some VC or investors' money. But the question is whether this story, this track record is enough to suggest a bright future ahead of us, and if they have enough money to continue in this long game. Over the past few days, the recent price action has seen Mullen's share price reaching around 26 cents, which is down by almost 50% compared to the peak of the stock. This price movement would be particularly bizarre, especially if we take into consideration of the latest news from the company itself of reducing its debt by approximately $13 million. The actual reasons why the stock might be down could simply be the overall environment, the interest hikes, the tendency for many shareholders to realize a slight gain or even loss to exit a position that they were overexposed to, or the additional short pressure that has resumed to make sure that the short squeeze doesn't happen. Usually this is the kind of price movement when people sell the news, meaning that they will sell the stock after the catalyst has been made public or been confirmed. The catalyst in this case being the IGO distribution contract in Europe, as well as to a lesser degree, the 13 million debt removal. Overall, the short-term price action suggests that the downward pressure needs to be able to stay there for a prolonged period of time before continuing up. I can't say for sure when it's going to occur, but finding a support and resuming the upward momentum have to happen so that we can buy into Mullen once again. Overall, the company has been having a mostly bearish trend over the past 5 years, having traded between $5 to $10 for many years before peaking around $15 and finally falling to around a penny stock level, about 25 cents in a recent month. What this says is that Mullen has been hard hit by the ongoing stock market downfall, and that its own fundamental weaknesses did not help. This assessment hasn't really changed yet, and also it kind of explains why Mullen is a stock that I would recommend to trade instead of investing in, regardless of the recent distribution contract, the possibility or the potential of a short squeeze, or the removal of its debt. The online communities, along with media outlets, seem to be skeptical about Mullen and the capacity to turn the company profitable. And it's also quite uncomfortable with the periodic lack of transparency, such as not disclosing key commercial partners or manufacturers of the iGo. Overall, Mullen is commented online mostly for its price action movements, the sporadic speculations triggered by the company's price, or the standard PR releases by the company itself. There isn't a huge amount of articles commenting about the company because as far as the company's own operations are concerned, outside of the financial markets, the lion's share of the volatilities or the operations and whether Mullen can stand the test of the time have yet to come. So for the moment, the trends within the EV stocks and the growth stocks have been under pressure due to increasing interest rates, the capital flights, the conflicts, and the bearish expectation of a recession. There are also some additional concerns, like we know that there will be supply chain issues, shortage of advanced equipments, the valuation model of the EV companies that could change from tech companies to just industrial manufacturers or car companies. And this can dramatically reduce the market cap. Because either way, we have to remember that market cap at the end of the day is something coming from people's imagination, right? We try to assess how much a company is worth based on how similar companies are worth or how similar companies are valued at. So another reason why Mullen should be an interesting stock to at least take a look at is that it doesn't always follow the trend, which hedges some of the sector-wide risks. Now, obviously, this is on a relative basis, as the recent price action also suggests otherwise. For example, when everybody goes down, Mullen goes way down, that kind of stuff. But also, when everybody goes down, Mullen can also go sideways or go up by 100% plus. So they're both for Mullen, whereas some other stocks, they simply follow the overall trends, and that's it. Now let's take a look at the company's financials. Regarding the cash balances, they have been increasing on a year-to-year basis, and it decreased somewhat from $105 million to $84 million. Overall, this is not a big issue, in my opinion, but it's also not suggesting, a very healthy and increasing cash balance either. I think that the cash balance that they got it probably from share dilutions and debts. So at the current moment, I don't think that they're going to go through another round of equity selling. So in other words, dilutions. So overall, this is a relatively good news. Now, the liabilities, in other words, debts. They have recently removed millions or tens of millions of liabilities, which is an excellent news to the long-term survival of the company. But we also have to remember that the market's timing is making things a little bit more difficult to read, with the share price falling sharply as a result to this news. This probably shows how the market is not always taking into consideration the company's specific fundamentals when it just wants to drive the price wherever it wants to drive it at. Now, there's also the issue of profitability. Mullen doesn't have any revenue since the beginning of 2021. It has its research and development expense increasing significantly, along with the general expenses slightly down. Overall, these are good signs, but operating losses will keep digging the hole deeper and bigger, in which at the end it'll force the company to dilute the equity once again if the situation persists. So hopefully it can be alleviated partially with the iGo distribution contract in Europe. Overall, I think what the financials of Mullen is telling me is that the big picture of the company is like a company that's doing its level best to stay afloat within its means, within what it can control. It tends to control its cash levels and to keep the expenses as low as possible, but still, positive cash flows need to happen to avoid dilutions, delisting, and the going concern issues. Now, let's talk briefly about its clientele. Its clientele is mostly retail with some commercial clients as well. The reason why I don't say business clients is that I think that the iGo mini EV cars are mostly good for the parcels and food deliveries. They're not necessarily good for other purposes. On the other hand, the vehicles developed by Mullen itself seem to be like vehicles that are targeting the same kind of people who would be buying Tesla, but maybe they don't have like the means to purchase one. So I would say that they would be looking for the medium and medium high-end clients. Now, regarding the shareholder mix, they're mostly retail, and there's also like about 6 to 7% of institutional shareholders. The retail traders tend to be volatile and reactive, and the institutional shareholders tend to be like long-term, or they try not to trade in and out too much. So with that being said, with around 95% of its shareholders being retails, I think that it's difficult to change my view about the fact that Mullen is a good company for trading, but not yet for long-term holding, because you don't know what the other 95% is going to do when the wind blows in the wrong direction. For example, Mullen has fallen by about 50% since its recent peak, around 50 cents. I didn't liquidate my positions, but how many people can you say for sure that they're going to hold till the end? You know what I mean? Or at least hold till when it no longer makes sense to hold it. At the same time, the lack of significant institutional participation also suggests that there doesn't seem to be much trust from the professionals, and that this is always required for me to put money into a company for the long term. Now, the risk factors, we have briefly mentioned them before, and they seem to be the interest rates, the VIX, the money supply issues. So because there's no more QE, but QT supposedly, conflicts around the world, the supply issues, and also the possibility of Mullen's shareholders losing faith. So these factors, more than a company's own like deliveries, models, qualities, tests, and so on, I think that these are going to color the ongoing discourse about Mullen. Now, we have also a possibility for a short squeeze. This is one of the major catalysts why people may want to buy Mullen. Basically, it has a huge amount of short orders, since a lot of institutions believe that it's going to go down. If the price goes up, they would have to redeem their positions to avoid further losses, which will act as a second wave of purchases. This is currently the biggest catalyst that really motivates a lot of traders to buy Mullen shares, which, by the way, may not occur at all, right? So we always have to remember this. It may not occur. It's not because something looks probable on paper that it's going to happen for sure. So going forward, we absolutely have to keep that in mind. So with that being said, let's begin with two questions. Number one, is Mullen a stock worth buying in the absolute terms? And two, is Mullen worth buying now? So the first one, I think the answer is yes. The company offers enough volatilities to make the trades interesting. And also, we cannot ignore the huge short positions that can simply carry the stock up mechanically, because there won't be any other direction for the stock to go if a large quantity of the short positions decide to redeem themselves. Redeeming meaning they would buy the shares back and give it back to the brokers. So this is the first one. The second one, is it worth buying now? I would say that I don't think that Mullen has identified a support level just yet. And I don't believe that being able to hold like the 26 cents level is enough for the short term, and let alone for the long term. So I think that they need to hold the stock at a level or above for at least, 3 to 5 days. If they can do that, I would think that the people who want to unwind their positions in Mullen have stopped doing so. And then we may be able to talk about like what's going to happen after. And in my views, I think that if Mullen can hold for about 3 to 5 days, this would suggest that we can continue purchasing Mullen shares for the future. Keep in mind that it should always be a stock that is on the margins. It's always a stock that's not something that you put in like 20% of your portfolio in. In fact, my recommended exposure for Mullen would be between 0.5 to 1% of your portfolio given the risk profile of this company. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach. which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.